thanks for joining me on my market report. My name is Mike, and my market report is on mortgage rates. We like to go over items like economic calendar, headline news, or geopolitical, because those are items that affect the most likely affect mortgage rates or impacting them. But sometimes the market sentiment could change and might be a little confusing because now good news is about bad news and vice versa. And so if you're watching this and wondering why rates are doing certain things, we try to give those explanations for you guys and give you the background information of what investors are thinking and why rates are doing what they're doing, and hopefully give you the information you need to make an informed decision, whether if you're looking to refinance or purchase, or you're just simply in the industry and want to kind of follow along what's going on out there. A little bit about myself is I am a loan officer. I do work with the national lender. We do loans in all 50 states. We love the opportunity to help you if you're looking to refinance or purchase. So if you're looking to purchase and need the pre-approval, we're here. If you're looking to get like a rate quote or run numbers for refinance, we're here for you guys as well. But more than that, we like to be a resource for you folks. So if you guys got questions or anything we can answer, please feel free to reach out. We're here to try to help you with what you're looking for. Meanwhile, why don't we just jump right into the report here? We'll start off with the economic calendar. Today's a big day because we got the big jobs data here today, and we'll start off with the average work week in hours for the month of March. So previously in February it was at 34.7 hours. So forecast was supposed to remain unchanged. However, it did slip 0.1% down to 34.6 hours. So not a huge movement right there. Now here's the number we're most likely looking at. This is the non-farm payrolls for the month of March. So February's number was actually revised much higher to 678,000 to 750,000. So extremely, that's a pretty big jump there. So obviously March was a much better month there. And then forecast were calling for 490,000. Came a little short, but still very well at 431,000. There's still a strong number there, and the market is pleased with it. Now, we also got the unemployment rate, which dipped from 3.8%. Forecast was calling for a slight dip to 3.7. However, it surpassed at the 3.6. So again, unemployment rate is looking very good as well. Average our earnings per month, or month over month. So February was revised from unchanged to going up 0.1%. And forecast calling for 0.4%. Came in at expectation of 0.4%. So what does this mean? More jobs, more people are taking jobs. However, they are paying them more. That's good news and bad news. People, of course, like to get paid more. However, on the other end, we are dealing with high inflation, and that is inflationary data there. So all those costs get passed on to other customers of those people that need to pay higher wages. So the good news is people making more money. However, people are making more money, but everything else is going up as well. Especially when we're dealing with high inflation. Construction spending, a month of February. So January was revised slightly higher from 1.3% to 1.6%. Forecast was counted for 1%. It came in much higher at 0.5% here. This is not a high impact one anyway, so it's not a big deal. The jobs data is what's a big one, and then of course this will have some impact here. The ISM manufacturing PMI for the month of March. So the previous report came out at 58.6. Anything above 50 is considered expansion. Forecast was supposed to show uptick at 59. However, it did dip a little bit in March to 57.1. So that was probably the most negative of the news. Now, again, the earnings is a double-edged sword because we all like to see earnings, but because we have such high inflation, that's the problem right now. We're seeing that just adds more to the inflationary data that we're going to see coming out further along, because obviously costs and goods and services will all rise as a result of that. Now, let's take a look here at the mortgage-backed securities, and that is what mortgage rates are. We are now currently down about 23 basis points. Now, we were actually down about 40, like a little over 40 basis points earlier, and have subsided a little bit. So we'll see if this momentum can continue. But we are down a little bit from yesterday. We are currently down about 23 basis points. So be careful out there. This jobs data, the stock market did like it. Stocks aren't all in positive territory. They felt that was the numbers were strong enough. The bad thing was, for the markets, what for them was It's nothing. It was strong enough numbers where the Fed's not going to alter their current plans on fighting inflation. So they've been seeing a lot of hawkish data out there, and basically the jobs data were strong enough where it should not alter what the current plan or route of what the Fed is looking to do in terms of fighting inflation. And right now, a lot of people feel that the next four rate hikes could be half a percent. So stay tuned in that category here. Now, the treasuries are down. We're up a little bit. We did go up a little bit. We're at 2.38 currently. We were down to like 2.32 yesterday, so we did see a bit of a rise. Of course, as you can see here, we were even higher, going as high as 2.4. So we were up about 2.4. Yeah, about 2.4 here range, or even higher, 2.4. Yeah, actually, we were even higher, about 2.45, 2.46 range. So we did subside a little bit, but again, we'll have to kind of watch and see how the markets continue to react as a result of this. Now, something else to take a note here is we did finally get the inverted curve. It's been coming very closely. So if you look here at the 2-year, we're at 2.438, and now the 10 years at 2.38. So the long term is now higher. I mean, the short term is now higher than that of the long term here, which means it doesn't mean we're in a recession. It just means that it has been a sign that we will, and there's a bit of a lag time that we'll probably see and it has to be, of course, it's not just a little dip here. It has to be over time period, consistent with that we continue with that. So if this is persistent, most likely we'll probably have a recession in sometime in the future. It could be anywhere between 6 to 12 months, maybe even longer. So just again, there's been always a lag time, but it's been an indicator of a recession coming. That's what that means. So last but not least, why don't we take a look at the mortgage rates, average conforming conforming loan size. Excuse me there. Sorry about that. And they do have points built into it. So a 30-year is now looking at 4.78%, and a 15-year is at 4.13. So much better than what we saw earlier in the week, where the 15 was around 4.22, and I believe we had touched about the 5% range, around 4.95 in terms of the 30-year fix. So those are average rates. Of course, these things could be changing in terms of depending on what variables are. There's a lot of variables that go into it. So whatever. But if you guys are looking for a rate quote, please reach out. We're here to help you guys. All right, folks. If you guys like these videos, please smash that like button and subscribe and share us. The greatest thing you can do is help us out by sharing us and let other people know about us. But also, if you guys have got questions, we are here to help you guys out. So if you guys got questions, give us a shout. Talk to you guys later. Have a great weekend. We'll look forward to see you guys on Monday. Thanks for watching. Bye-bye.